Good morning, everyone. Today, we're going to go over chapter 10, which is about long-term liabilities. And specifically, we'll be going over bonds and installment notes. Now, for a deeper understanding of the content, I do have these short videos that would explain to you in more detail about these accounting issues there. So, but anyway, this is meant to just get to jumpstart you an overall picture of how to journalize. And I see there's some good things that you're going to need to know for doing your homework too. So without further ado, let me go ahead and share my screen. We'll start out with okay, we'll start out with a PowerPoint. Usually I don't, but this time I just want to share a few things with you. And I'm going to switch this. There we go. Okay. So when you think of bonds, think of notes payable. It's a type of notes payable. And generally, organizations issue bonds to obtain large amounts of capital. Matter of fact, you know, you probably voted for some bond issues on the ballot, right? When municipalities or the state wants to raise money for something. Okay, the advantage of a bond is that it doesn't affect ownership interest. So, you know, if we issued common stock, then everybody's shares are going to be decreased by more owners. So the ownership doesn't change. It's more like a liability. Okay, so I'll just show you this. And when you think about bonds, it's different than maybe a notes payable, a regular notes payable, where you sign a note at the end of the maturity date. On the maturity date, you're going to pay back the principal and the interest. Well, in a bond, you're going to have to pay interest generally every 6 months, right? Just like this illustrates here. Okay, and at the end of the bond, it'd be the maturity date, then you're going to pay back the principal too. But that's the whole thing. You're going to be paying interest payments usually every 6 months until the end of the bond period. Okay, so I'm going to see what else I can do here. I'm going to move this. I'm just highlighting certain things. You can see this in your videos that I did. This is actually a very good slide because it tells you all of the journal entries that you're going to make related to bonds. And so when you issue a bond, of course, you're going to receive cash. And then you have to sign the note, or it's not a note, but it's the bond. And basically you owe the money. And then every 6 months, you're going to pay interest expense, right? So debit interest expense, credit cash. Now, in real life, when you issue a bond, the rate that you're offering will be different than the market rate. So you might be offering 8%, but in the market, they're earning 10%. So the investor will go, well, why should we buy your bond and for 8% when we can go on the market for 10%? So when that happens, we have to issue the bond at a discount. And in our problems, they'll always tell you how much we're getting for it. The difference between how much we're receiving and how much we're going to owe at the end is going to be our discount on bond payable. Now, as we're going to demonstrate this shortly here, that if you sell your bond at a discount, you're going to be paying back money that you never received. So let's say you owe 100, but you only received 80. Well, the discount is 20. Well, that 20 is the discount, and you didn't receive that money. If you received 80, but you owe 100, you got 80, but you have to pay back 100, then that's going to be extra borrowing cost. So as I'm going to demonstrate for the bond interest, that we're gonna okay, you're gonna love this. We're gonna amortize the bond discount. You go, oh no, that must be hard. Well, all we're doing is we're allocating some of the discount to interest expense. Instead of doing all at one time, we're going to match it against the interest expense. So when you allocate part of the discount, it's going to increase the interest expense. And I'm not going to tell you, go into great detail about the premium, but when you sell it at a premium, you're getting more money than you have to pay back. So that extra money you're getting is going to offset the bond interest. So as you're going to see that when you amortize, I hate that word because it's scary, but that's what we call it. It's just allocating part of the premium over the life of the bond. So when we allocate it, the premium, it's actually going to reduce bond interest expense. So we'll see how that works. One more slide before I get going. I really like this slide. All right, now, and this would be like a test question, and you're going to get it, when you study and prepare for it. But if your contractual rate of the bond, that's what you're paying on your bond, is 10%, but in the open market, they're only paying 8%. What are you going to sell that bond at? At par, which is the face value, at a discount, or a premium? Well, yeah. I mean, the investors going, okay, we'll buy your bond at 10%, and you go, not so fast. We're offering 10%, but in the open market, you can only get 8%. So you're going to have to pay us a little bit more. So in this case, when we're offering a rate that's higher than the market, we can sell it at a premium. Now, what happens if our rate that we offer is 10%, and on the open market, you can get 10%? Well, then you're going to issue the bond at face value or par value. It's kind of, those terms are kind of interchangeable here. Now, how about this one? We are offering 10%, but in the open market, the investor can get 12%. And so they're going to say to you, why should we buy your bond at 10% when we can go and get 12% on the open market? And you go, I realize that. So we'll give you a discount so that you'll still get your 12% return. So in this case, you're going to sell it at a discount. So that's kind of what we're doing in a nutshell. Like I say, read your book. Also look at those short videos. Each of them are like 3 minutes long, and it kind of tells you, breaks it down and tells you about all these things. I just wanted to kind of prime you a little bit, because for many of you, this may be your first experience in chapter 10. So anyway, I'm going to go stop the share. And now I'm going to go to my trusty iPad. Okay, so when you go to your Canvas module for chapter 10, what I say, bring to the Zoom session. This is what you would bring, right? So it's there. Now, I will tell you that these numbers, like Quick Study 10-2, Quick Study 10-6, These are related to the 7th edition, right? So our numbers will not correspond to our new textbook because we're in the 9th edition. I just said, do I have to go all this work just because of the publisher and the author switched the numbers? I said, nah, it's the same thing. So just know that if you look in your book and you go, I don't see it there, well, it's because it's a different order. But what's cool about this, in this particular handout, I give you the whole problem. I mean, it's all there. So you don't even have to refer to your book at all because it's all here. Okay, let's go ahead and read about journalizing a bond. Enviro Company issues an 8% 10-year bond with a par value of $250,000 and semi-annual interest payments. On the issue date, the annual market rate for these bonds is 10%, which implies a selling price of 87.5. Prepare the journal entry for the issuance of the bonds. Assume the bonds are issued for cash. I remember as a student, I can't remember all of these numbers and all this information. It's hard. So what I generally do is I underscore key things, right? First off, if I'm just going to walk you through this, if you issue bonds at 8%, but the market rate is 10% in the open market, well, you're not offering market rate. So you're going to have to issue these bonds at a discount. We're offering 8%, but the investor can get 10% somewhere else. So we have to issue it at a discount so that it's equivalent to 10%. Now, in our problem, because this is like an introduction to accounting class, and I kind of laugh at that because this is hard stuff, but still it's introductory, that we're going to give you the selling price. And this just means that we are going to sell these $250,000 worth of bonds at only 87.5% of that, right? So then when we issue the bonds, well, how much cash are we going to receive? Well, 87.5%. If you multiply that out, you debit cash, right? And then you go 250,000 times 87.5%, you are only going to receive 218,750. However, you're going to owe at the end 250,000. So that's credit bond payable 250,000. The difference between what you received and what you owe at the end will be the discount or the premium. Well, in this case, it's a discount because we're only receiving 218,000. Notice when you get done, debits equal credits. And the reason why I put this in the box, this discounts on bond payable, because that's what you've got to figure out. You know that you're receiving 218,000. At the end, you're going to be having to pay back 250,000. So now that means that there is 31,250 that you're going to have to pay back that you never received, right? You only got 218. You now owe 250. There's 31 right here that you're going to have to pay back that you never received. And as you're going to see, we're going to allocate this in parts over the life of the bond. And that's this as we allocate it, and I'll call it the A word, the amortize, you're going to amortize it. This amount is going to increase bond interest expense. And we'll see how that goes. So anyway, that's how you do it. The first one, you don't even have to worry about the 8 and the 10% at this point. You just want to record the bond. So here it is on January 1, cash, debit, 218,750, debit, discount on bonds payable, 31,250, credit, bonds payable, 250,000. Okay. Now in this one, I'm going to demonstrate the true interest expense, right? I told you that if you issue bonds at a discount, then as you amortize that, it's going to increase the interest expense because you have to pay back money that you never received. And this problem here walks you through the process. And I think you might even have to do this in your homework. Okay, let's read it. Oh, we're going to use a straight line method to amortize the bond discount. There's another one. It's in the appendix, and I'm just not going to go there because I think if you just get the basic idea, when you get to your intermediate accounting for you finance majors and accounting majors, they'll teach you how to amortize that using the other one. I think it's called the effective interest method, but we're not going to do it. We're going to do the simple one, straight line. Okay. Enviro Company issues 8% 10-year bonds with a par value of $250,000 and semi-annual interest payments. On the issue date, the annual market rate for these bonds is 10%, which implies a selling price of 87.5. The straight line method is used to allocate interest expense. If you notice, it's the same information as we did the first problem, but we're going to take it one step further and talk about interest expense. Okay, number one, what are the issuer's cash proceeds from the issuance of these bonds? Well, the bonds we're going to issue are $250,000, but yet the selling price is going to be only 87.5% of that. So the cash proceeds would be, the value of the bonds times the 87.5%. Now, I like to work with decimals, so I'm going to convert that 87.5% to 0.875. So my cash proceeds, 250,000 times 0.875 equals 218,750. Notice that that's the same answer we got above, right? I mean, there it is. That's what we just did. It just looks different. Okay. What total amount of bond interest expense will be recognized over the life of these bonds? Well, the total interest expense is going to be made up of the interest payments, of course, what you actually pay in cash. But also, remember when we said we issued our bonds at a discount? Well, that means that we didn't receive all the money, but yet we owe it all at the end, right? So, like I was showing you here, we received 218, but we're going to have to pay back 250. So there's 31,000 that we never received that we have to pay back. We have to add that to the interest cost, right? It's another borrowing cost. And so that's what we're doing here. So we're going to start out with the interest payments. So remember, interest is calculated by principal times rate times time. So the par value, the face value is 250,000 times 8%. It's an 8% bond, right? I'm going to convert that 8% to a decimal, 0.08 times 1/2. Now, why 1/2? Because if you notice here that we're going to have semi-annual interest payments, right? So that's every 6 months, every half of a year. So that's why the time is 1/2. Now, you say, well, where did you get, 20? Well, remember, these are 10-year bonds, right? So, and each year we make 2 semi-annual payments. So if we make 2 every year for 10 years, we're making 20 payments, right? 20 semi-annual payments. That's where I get the 20. Okay. So over the life of the bond, we'll be paying interest of 200,000. But wait, there's that extra borrowing cost. We have to pay back money that we never received. That's our bond discount. And how do we calculate bond discount? Well, it's going to be we have to pay back, which is 250,000. The face value or the par value, and minus the cash proceeds. And we know the cash proceeds here are 218,750. So that goes there. So the bond discount is 31,250. We add that together. That is going to be the total bond interest expense over the life of the bond. Okay. We calculated this up here too, right? Look, 31,250. 31,250. It's the difference between how much we received and how much we actually owe, right? It just looks different, but we already did it. Okay. So number 3, what is the amount of bond interest expense recorded on the first interest payment? Well, remember, if interest expense is 231,250, then and we're going to have 20 periods. That means we're going to have to record interest expense of 11,563. See that? We need to move this to interest expense. Well, we're going to do that every 6 months. We're going to recognize 11,563, and at the end of the 20 periods, we'll have recognized the whole interest expense of 231,250, right? Because 11,563 times 20 would equal the 231,250. Now, I will tell you that you have to round a whole dollar. So when you do it that way, it's going to be a little bit off for rounding purposes. And when you do your homework, I think if that's going to happen to you, in the instructions on Connect, they'll tell you to round it and stuff, because that's just the way it is. They're trying to make it simpler. Okay, so that really ends this problem. I do take it a little bit further just so you can see what's happening. So if you did record the first interest payment, you would debit interest expense of 11,563. Now, what is this made up of? Well, the actual cash interest payments, right? You're going to be paying actual cash out in interest, and you base that on principal times rate times time. The par value or the face value is 250,000 times the 8%, which is 0.08. I like to convert that, times 1/2. So we're going to recognize $10,000 of actual interest expense that we paid in cash. But then we have to allocate some of that money that we didn't receive, but we have to pay back. We're going to amortize our bond discount. And how do we do that? Well, here's our bond discount. It's 31,250, and that's the whole amount. And so if we divide that by 20, that's where we get the 1563. Now, that's how I learned it in my textbook way back in the day. I just knew what the bond discount was, and I know which is 31,250, and I know there's 20 periods. So I'm going to allocate 1/20th of that 31,250 every period, right? I'm going to allocate that entire bond discount 1/20th every year. At the end, it will all be allocated. You're going to see later that your book that does it a different way. And I mean, when I looked at it, when I was first teaching out of this book, I go, what? That's weird. And So I think you're going to really like me doing this problem. The next one for you, when we see, what are we doing here next? Yeah, when we start using this schedule for doing your journal entries. Okay, so let's go ahead and do that. Quick study 10-7. Okay, we're going to record the bond issuance and then record the discount amortization. Remember, amortization is just another word for allocate. It's kind of like, for, when we allocate a truck, the cost of the truck over its useful life, that we call that depreciation. So for a truck, we allocate depreciation. When we allocate a discount or a premium, they call it amortization. So it's kind of like depreciation, just as a systematic allocation, Anyway, let's read about this. And this is how your homework is going to be. So this is a good one. So pay attention on this one. This is one of the reasons why I'm doing this video for you, because this may throw you. All right. Sylvester Company issues 10% 5-year bonds on December 31 with a par value of 100,000 and semi-annual interest payments. Use the following bond amortization table and prepare journal entries to record A, the issuance of the bond on December 31, and B, the first interest payment on June 30th, 2017, and C, the second interest payment on December 31, 2017. All right, there's a lot to do. Let's break it down. We're going to do A, issue the bonds. Well, all the information you need is right here. So when we want to issue the bonds, and we're looking at this, see that carrying value and that unamortized discount? Well, that means that we sold this $100,000 bond for $92,640. So just remember then, when you receive the cash, this is the first thing you do in line 0 here at the very beginning. That means this is the amount of money you're receiving, the $92,640. So debit cash, $92,640. Okay, see that? It's taken right from the schedule. And then here's the unamortized discount, $73.60. So you're going to debit discount on bonds payable, $73.60. Okay, and we know it's a $100,000 bond, right? So we're going to credit bonds payable of 100,000. Okay, again, it's bonds payable because they say it's 100,000. So we put that down for bonds payable. We know that we only received 92,640, right? So that's the cash received, 92,640, and the difference between what we received and what we have to pay back is our discount on bonds payable. Okay, now it says B, the first interest payment on June 30th. So it's really 6 months, right? So this is how we're going to do it. That, well, just put down, on June 17th, 2017, June 30th, we have bond interest expense, and we don't know what it is. I guess I could, maybe even put this like this, so it kind of like, that's the last thing that you do. So we got to find out, well, how much cash are we actually paying in interest? Well, we know that the face value of the bond is 100,000. That's what we have to pay back. And that's what the interest is based on. That's the principal. And we know that it's 10%, right? It's up here. And it's for half of a year. So principal times rate, that looks so weird. Oh, no, it isn't. It's fine. This is 10% or 0.10. I guess I can change that a little bit, make it nicer looking. Yeah, that makes it look better. So that would be 5,000. But wait, we have to allocate part of our discount on the bonds, right? So normally what I would do, I would just take that. This is how I would do it, but this is not how they're going to have you do it. I would just take that 7360, which is the full amount. And we know that it's going to be 10 payments, right? Because it's 5 years, over 5 years, 2 payments every year. So that'd be over 5 years, that's 10 payments. I just go 7360 divided by 10, and that's how I'd get that. That's how I would do it. But how they're making you do it is the schedule. So you know that if you started out with 7,360 and you ended up with 6,624, you allocated or amortized the 736. So it's this right here. It's 7360 minus the 6624 is 736. So again, I'm going to tell you my way. I know that the total discount before you allocate anything is 7360. You're going to do this over 10 periods. I would just go 7360 divided by 10, which would give you your 736. That's how I would do it. Your author thinks it's better to show the amortization here, and you've got to figure this out. That kind of, like I say, that threw me for a loop at first because I wasn't used to doing it that way. All right. So then if you know that the actual cash payments of interest is 5,000 and you're going to allocate and the discount on bonds payable of 736, you're amortizing the bond discount. So the total amount of bond interest expense would be your interest payments plus the amortized bond discount. So that's bond interest expense of 5,736. Remember, discount will increase bond interest expense, right? Because you have to pay back money you never received. And we're going to we don't do it in one fell swoop. We allocate it evenly over the life of the bonds. So there you go. So C is the same thing. It's the same entry. Look at that. It's the only difference is well, let's go ahead and do it. The cash, again, it's 100,000 times 10% times half of a year, right? Principal times rate times time. So every 6 months, it's going to be the same amount of interest payments, right? So that's why it's the same on June 30th as December 31. And also because it's straight line, and we're going to allocate it evenly over 20 periods, it's going to be the same thing. You're going to amortize the same amount, 736, right? Again, I just know that because it's a straight line, it'd be 7360 divided by 10, and that's where I get the 736. Your book, though, wants you to do this. It wants you to see, well, the unamortized discount was 6624, but now after we do our entry, it's 5,888. Well, what's the difference between 6624 and 5,888? Well, that's how much we allocated. So that number is, again, 736. So that's how they want you to do these problems. They want you to look at the schedule and see how much was amortized by looking at the unamortized portion for each period. Okay. Now, we are now going to talk about premiums. Premiums, okay? So notice, well, notice here that Garcia is issuing 10% 15-year bonds with a par value of $240,000. In the open market, the annual market rate is 8%. So guess what? We're issuing 10% bonds, but in the open market, you can only get 8%. So I'm sure that the investor goes, we'll take the bond at 10 to 10%. And you go, not so fast. You know, you can only get 8% in the open market. We're offering more at 10%. So if you want our bond, you're going to have to pay us a premium more. Now, in our problems, they're always going to give you how much more. They're going to give you the selling price. And in this case, it's 117.25, right, which is a quarter, 117.25% of this 240,000. You know, in your intermediate accounting, when you probably get it, when you get to Fresno State or whatever, you finance majors and you accounting majors, they're going to make you use present value tables, and you're going to have to figure out that premium or discount. It's very cool. I love the time value of money. It was very interesting to me, but I feel that it's just a little bit overkill for our class right now. I'm happy if you could just journalize this, you know, and be happy that you understand how to, you know, record a bond discount and bond premium, and how to amortize that discount or premium. And I'm good with that. So you guys, if you really want to know, you can read the appendix, or you can wait till you get to Fresno State. It's pretty interesting. I like it, but like I say, we're going to stop here. Let's go ahead and then record the bond. Well, how much money did we receive? Well, we're receiving 117.25% of the par value. So 240,000 par value times the selling price, which is at 117.25%. So we're receiving $281,400. Now, what's cool about that is that while we received $281,400, we're only going to have to pay back $240,000 because that's the par value. So let's go ahead and put the par value is bonds payable of $240,000. So we received more than we have to pay back. So that's where we record premium on bonds payable. Now remember, premium on bonds payable this time is going to be a credit, right? In this case of $41,400. It's the difference between how much we received and how much we had to pay back. It's interesting that when you have a bond, you allocate or amortize. Can I just say amortize? I don't want to scare you, but you guys kind of get the picture. I'm just going to say amortize from now on. But all it is we're allocating part of it. So it's a credit. And anyway, when we amortize this is going to reduce interest expense. Why? Because we received money that we don't have to pay back. So we're going to receive money that we don't have to pay back. So that's going to offset our interest expense. And anyway, I'm going to show you something here, just to show you. Have you noticed like that on a bond discount, we're going to debit that? That's just extra interest expense waiting to be allocated. You know, interest expense is a debit balance, right? And so is the discount on bonds. So we're going to take it out of this account and add it to interest expense. So that's a debit, and that's why that's why it increases the interest expense and when you allocate it. Here, it's a credit. That's almost like revenue, right? So it's going to offset when you allocate this. You're going to allocate it against the interest expense, and I'll show you how that works. So anyway, January 1, debit cash, 281,400, credit premium on bonds payable, 41,400, which is a plug and chug number, and then bonds payable 240,000. Now, like before, we're going to calculate the proceeds, and we're going to also calculate bond interest expense. Okay, so here we go. I think it's the same. No, it's a different information. Okay, so we've got Enviro Company issues 8% 10-year bonds with the par value of 250,000. And the market rate is 5%. Well, check this out. You know, right off the bat, it's going to be a premium. Why? Because we are offering 8%, but the market is only 5%. So of course, the investors go, we'll buy your bond at 8%, and you go, not so fast, because we know that you can only get 5% on the market. So if you want our 8% bond and get more interest, you're going to have to pay us more for it. And because of that, the selling price is going to be 123 3/3% of the par value of that bond, or the face value, the 250,000. Okay. Now, just they're killing me with all these fractions and stuff. I'll just let you know how to calculate this. This 123 3/3%. Well, if you just bring over the 123, right, and that 3/8, if you go 3 divided by 8, 3 divided by 8, that's going to be 0.375. So tag that on to the end. So you would go 123.375%, right? 123.375%. But I don't like percent. I like to convert mine to decimal. So to do that, to convert a percent to a decimal, you just go over 2 places. 1, 2. So that 123.375% in a decimal form is 1.23375. I know they're killing us, huh? And does that make sense? Because 100% is 1. So that's what that 1 here is 1. So you can kind of think that through. I wish they would have made it a little bit easier, but they didn't. I'm sorry. I didn't write the book, but I did explain it. So hopefully you'll be able to figure that out. This truly is worthy of your intellect. It's one of the harder classes, for your degree. So as you know, I'm trying my best to make it easier for you, but even with me, I had to work super hard at it. It's just the way it is. Okay, so what is the cash proceeds? Well, it's going to be 1.23 or 123.375% of the 250,000. So we know that the bond's cash proceeds would be 250,000 times, I converted it to a decimal, 1.23375, and you're going to come up with $308,437.50. Now, your Connect is going to say, if you come up with cents, round it. They'll have to tell you that. So we're going to round that up to 438, right? That would be instead of 0.75, that's going to be 8,438. So we're going to round it to the nearest dollar. Okay, now let's figure out our total bond interest expense. Okay, well, again, what are the interest payments? It's going to be based on 250,000 times 8%, because it's 8% bonds, right? And it's going to be for half of a year. So principal times rate times time. The principal is the par value, 250,000 times 8%. I just like to change it to a decimal, 0.08, and it's for a half of a year. Now, well, how many periods is that? You know, I mean, how many times are we going to do this? Well, it's a 10-year bond, right? And we do these interest calculations every half of a year, right? Semi-annually, 2 of them. So that means 2 a year for 10 years. That's 20 periods. So that's why we go times 20. So there it is, 200,000 of actual cash interest payments. But wait, we've got to amortize our bond premium. And remember, our bond premium is money that we received, but we don't have to pay back. So it's going to reduce our interest expense or interest cost. Why? Because it's going to offset it. So of these interest payments, we're going to, because of our bond premium is, I guess I need to calculate that, right? Our cash proceeds of 308,000, actually 308,438 minus what we have to pay back. This is what we received. This is what we have to pay back. And so our bond premium is 58,438. So we reduce our interest cost by that. So our total bond interest expense over the life of the bond is going to be 141,562. Okay. Now, number 3, what is the amount of bond interest expense recorded on the first interest payment? Well, just know that this is the total amount of interest, 141,562. And we're going to allocate that for 20 periods. So we're going to divide it by 20. So each period, we're going to recognize 7,078 in interest expense. Okay. Wow. I know this is harder stuff. You know, what I had a hard time with was those bond discount and premium amortization tables. And you're going to see that, you know, as you amortize the bond, it's the carrying value is going to finally reach the face value. And I'm not going to get into that. I mean, I might as well just go ahead and give you the whole lecture. Look at my videos, and I kind of explain that. But that's kind of a tough thing. But this really does help you with homework and get you jump started. Okay. Now, should I just tell you that on bonds, you know, you guys probably aren't going to be, most of you aren't going to be recording bonds and all this. And we do it as an academic exercise. And some of you finance people, well, definitely the finance people are going to work with it. And the accounting people are going to probably work with it. But most everybody else, are you really going to be recording and amortizing bond discounts and things? Probably not. One thing that this is very practical, and I know everybody's going to experience this, is installment notes. If you got a car loan, you signed an installment note, If you bought your house, your mortgage, you just signed an installment note. And it's a little bit different than a regular notes payable like we've been doing, where the interest, you pay back the principal and the interest at the end of the life. We call that maturity date. Well, in installment note, each payment, part of your payment is going to go to interest and part of it is going to go to principal reduction. And so let's just kind of go over it and I'll show you how it works. On January 1 of 2017, MM Company borrows $340,000 cash and signs an 8% installment note for 5 annual payments. And they give you the payments, $85,155. You know, what's really interesting is in your finance class and in your intermediate accounting class, they're going to make you calculate that payment. So, and I'm going to give you a spreadsheet. It's going to be my gift to you that you can use to calculate that payment. But what's nice about our book, and I'm not going to go any further. I'm not going to do time value of money. I'm going to show you mercy, right? If I was a student, I would want to, my instructor to be merciful to me. So it's always, I'm just kind of kidding, but it's kind of extreme. But anyway, they're going to give you that cash payment. So let's go ahead and journalize the issuance of a note. Well, it's pretty easy to issue it. You're borrowing $340,000. And so debit cash, $340,000, credit notes payable, $340,000. That's it. Now, this is where it's different. For the first, this is number 2, for the first $85,155 annual payment, what amount goes toward interest expense and what amount goes toward principal reduction? Okay, so this is how we're going to do it. You got to have a schedule. Our cash payment is given. It's $85,155. So our cash payment is $85,155. Well, that payment has to first pay off your interest, and whatever's left over will reduce your principal. You know what's really interesting? I have a loan, a mortgage on my house, and I'm trying to get that my house paid off within 10 years. And so to do that, I have to put in extra money so that it will reduce the principal. So you know what I did? Like just recently, let's say my cash payment was $85,155. Well, I know that the interest expense, it would be set at $27,200, and my principal reduced $57,955. What I did, I added more money so that then this principal would reduce further. And when I do that, next month, I'm going to owe less interest expense, because in installment note, your amount of interest expense is based on your unpaid balance, right? On your principal balance. Okay, I don't really show you that here, but when you read the book, you look at my videos and everything, you'll see that happening. So that's what I do. I put a little extra money, and it really does cut down. I mean, I'm going to take a 15-year loan, and I'll pay it off in 10 years. Okay. So anyway, how would we book that? I don't think that they even ask you about this, but I'm going to show you how that works. So of this cash payment, where we're going to credit cash of $85,155, it first goes to pay off the interest expense. Now, how do you calculate interest expense? Well, it's based on the outstanding balance. And so here, interest expense of $27,200. Well, we start out with $340,000. So 340,000 times 8% for that full year, 27,200. All right, so that's where I get the 27,200. Okay, it's interesting that next time around, it's not going to be based, the interest will not be based on 340,000. It's going to be, well, what is that? That's 340,000 minus the principal reduction of 57,955. I guess I can do that for you just right here. Yeah, next time I'm going to be multiplying the interest rate by 282,000, right? Because I reduced my principal. Okay, again, as far as the entry, debit, I mean, you're going to credit cash of 85,155, and you're going to pay off the interest expense, and then the rest will be a reduction of your notes payable. Okay. The last thing I'm going to share with you, and I think you're going to like this. This is my gift to you. You guys see this? I have given this to you. Now, yeah, maybe I haven't made you share it first. There it is. This spreadsheet is a car loan payment calculator. And I used to teach Excel, and we did this, and I use this today. So let me show you how this works. And you have access to this. This is in Canvas in the Chapter 10 module under Car Loan Payment Calculator. Let's say that you want to buy a Honda Accord. I'm just going to guess. I don't know what it is, but let's say it's $30,000. Put 30,000 in. And you think that the interest rate you can get is 3.9%, and you're going to finance it for 60 months. Okay, that means your monthly payment is going to be $551.14. And you go, dang, I can't afford that. What happens if we change it from 5 years, which is 60 months, to 72 months? And cars are getting so expensive today that they're doing that. You can go as far as 72 months. Let's do 72 months. That's a little more manageable. Over 72 months, your monthly payment is going to be $467, you know. And this also tells you how much all your payments are going to be, the total payments. And it'll also show you how much this is costing you in interest over the life of that loan, right? And as a kind of a funny story, I bought a car, and I was financing it, and I knew how much my payment should be. And when my banker was ready to close the deal, I said, "That's not right." And she looked at me very arrogantly. "Who are you to tell me that I am wrong and you are right? I'm the banker." I said, "I'm telling you, it's not right. I know what it's supposed to be." And what she did is she gave me a 72-month loan. I guess everybody wants 72 months because they're so poor and they've got, you know, the cars are so expensive. Well, I'm later in my life. I've got some money. I just did the right thing. You guys will be there too if you're not already there. But I wanted it for 60 months. So when she put it in 60 months, I was right to the penny. I said my monthly payment should be this. And when she did it, she goes, "Oh my gosh." And she goes, "Who are you?" I said, "I'm Richard Tuttrup, CPA. And I teach this at Fresno City College." And she goes, "Oh, okay." So it was actually her mistake. But the thing is, when you have knowledge like that, you can really take control. I mean, if I didn't know what I was doing, oh, okay, where do I sign? And also when you go for a car, what kind of monthly payment do you want? And I don't do that. I say, you don't worry about my monthly payment. You give me the best price. I'll worry about the monthly payment. And so we dicker from there because they know that most people don't understand this stuff. And so, well, we'll give you a good monthly payment. Yeah, it's a low payment, but you're paying it for 30 years. It's really stupid. I mean, you guys, as your instructor, I want you to know this to be prepared because, the bonds, you have to learn it. It's part of a curriculum. But man, this installment note stuff, you are going to be experiencing this. You are probably going to get a car loan. You're probably going to get a house loan if you don't already have one. And this is how they do it. So look, for a practical matter, make sure that you look at that installment note. It's pretty interesting. And keep this spreadsheet, this car loan payment calculator as my gift. And in the future, you too can go car shopping. And before you even, get on the lot, you can kind of play with the numbers and you know what to kind of expect. And don't be at the mercy of that car salesman or that finance person who assumes you know nothing. All right. That does it for me. So I hope you enjoyed the show. We'll see you then next time for chapter 11. Take care. Bye-bye.